Now, before we begin, it's my pleasure to introduce our speaker for today, Xuan, with a background of a degree in economics from University Malaya. Currently, Xuan is the general manager of Alcopedia Sendiri Berhad, which is a proprietary trading firm in Malaysia specializing in algorithmic trading. He has over 5 years of content creation experience on personal finance and investment through his personal blog called nomoneylah.com. Besides that, Yishuan is also featured in various media such as City Plus FM, BFM Taijing, and others. Without further ado, I am delighted to hand over the presentation to Yishuan. So Yishuan, there you go.
And thanks, CY, for introducing me to the session today. Thank you so much, CY. So I want to again welcome everyone to the session today, and to our topic today is where we will debunk some of the myths in gold and also the true opportunities in this precious metal. Now, let's quickly go through what we are going to first of all, again, before we start, a quick disclaimer here is that this presentation is only for general information. It's not intended as an investment advice or to buy or sell any stocks or futures or any investment products in this case, right? Stocks and futures are imply risk and to be undertaken only if you understand the risk. So please seek your own tax, legal, and financial advice before investing in stocks and futures. Now, again, all information in this presentation is subject to change without notice. Now, let's go through what we are going to talk about today. So there are a few key things that we are going to discuss today about gold, right? Mainly, I want to first start off with by debunking a few assumptions or myths about gold that people tend to assume, right? And this will change how you think about gold entirely from today's session. Now, moving forward, we also discuss, for some of you that are traders or investors, we are going to discuss some of the key opportunities, right, in gold that you can focus on right now. And thirdly, we are going to talk about how to trade gold through gold futures and what are some of the advantages and benefits of trading gold futures, especially FGLD listed in Malaysia. Now, lastly, we are going to compare, there are so many options to get yourself exposure to gold. What are some of the options there and which one suits you better? So I'm going to compare gold futures, gold exchange traded fund or ETF, and physical gold. Now, before we continue, just a question to everyone here today. Who among you actually hold gold in your portfolio right now? If you hold gold in your portfolio, just say yes, right? Just reply yes in the comment section. All right, great. So now I have another question while you guys answer. Let's move on to the next question. Now, in your opinion, for those of you that invest or have hold gold in your portfolio or doesn't hold gold in your portfolio, what do you think? Why some of these investors or traders, they choose to hold gold in their portfolio? Any key reasons? What would you think? What are your opinion on why people invest or hold gold in their portfolio? Any key reasons? All right, now today, right? There are some of you say safe haven, some of you say insurance against inflation, some of you might say it's a stable asset, right? So right now, let's jump straight into debunking some of these assumption, right? Because there's this assumption that gold is a stable asset. I think this is sort of like a norm that people tend to have keep in their mind when they think about gold, right? So the first myth that we are going to talk about today is gold is a stable asset, or is it really, right? So to talk about this, let's move on. I want to show all of you a visual over here in this chart. Now, so in this graph over here, what you can see is gold on your top left compared to others other asset classes in the market like stocks, right? Like real estate investment trusts, bonds, and even home prices in the US. Now, what you can see, how do we usually visualize volatility, right? So volatility is in a way the opposite of stability, right? When an asset is volatile, it tends to swing up and down in a very frequent manner, and in fact in a very large extent, right? So now what I want to all of you to focus on is on the top left corner, top left corner, where gold is where you can see the graph of gold. Now, what you can observe here is gold, right? Despite the assumption that gold is a stable asset, over the past 50 years, from 1972 to 2021, the gold movement swings up and down, right? It shows that it is actually a rather volatile asset, especially when you compare to, if I want to bring your attention to the blue color and the brown color graph, which is the US bond and the US home price. So in this case, right, we already have a basic idea that gold is actually quite a volatile asset class. Now, what about gold versus, let's say, the stock market, right? So right now, I want all of you to actually focus on gold and the chart on this right, which is the S&P 500, which tracks the top 500 listed companies in the US. Now, what you can see here is actually, right, gold swings, the extent of gold swinging up and down is actually pretty similar to the S&P 500. And in fact, if you observe closely, right, what you can see is gold actually the times of gold swinging down, it actually happens more than the S&P 500, which is the US stocks. So what can we say? What can we sort of deduce here? This sort of deduce that gold is actually a volatile asset, right? So the assumption that gold is a stable asset is actually pretty it's a wrong concept in mind. So when you approach gold, right, you gotta have this assumption that gold can be quite volatile in nature, especially when you compare to things like the bonds, the home prices, and even the S&P 500. Now, with that in mind, this is not the only kind of a myth that people have towards gold, right? The second myth that I want to bring out is, some of you mentioned just now that gold is a good protection against inflation, or in other words, it tends to protect our wealth again when the inflation is high. But is it true, right? Is it true that gold actually protects our wealth or protects our buying power when the inflation is high, right? For this case, I want to introduce all of you to this table over here. So how do we define in this how do we define whether gold is a good inflation hedge or not, right? For this discussion, I bring up the years where the US inflation is over 4%, which means the inflation is higher than 4%. So as you can see, from 1973 to 2022, right, all these years are the years where inflation is higher than 4%. And what you can see over here, the next graph, I will show you, right, how gold performed in all these years where inflation is over 4%, right, which is high inflation, right? Now, from this chart, right, take a look. Let it dive in a little, right? What we can see here is that gold, right, actually swing both ways when in the years where inflation is high, right? So what does that mean? This simply suggests that gold, where people tend to assume that gold have a positive relationship over inflation, it actually isn't as strong as what people tend to assume, right? In fact, gold tend to swing up and down in the years where inflation is high. Now, what does that mean, right? So this means that the general assumption, number one, that gold is a stable asset. Number two, gold is a good protection against inflation is actually a flawed assumption, right? Now, if that's the case, a question that we got to ask ourselves is, what are some of the opportunities in gold, right? Because the usual assumption or usual norm about gold is wrong, then what are the opportunities in gold, right? This is a question that we got to ask ourselves. Now, with that in mind, right, I want to, there's a good news I want to share with everyone, because there are indeed opportunities in gold. It's just not as, it's just in different way, where some of you may not have figured it out yourself, right? So in this case, this is where I'm going to share with you the real opportunities that we see in gold. Now, the first opportunities here is, now as we talked about just now, right, gold is a volatile asset by nature. So what does this mean? This means, right, existing gold investors. So for those of you who are holding gold, right, what you can do is that you can use instruments like the gold futures, listed in Malaysia, like FGLD, to hedge against any downside risk in gold. Now, how do we measure volatility? volatility, right? You can, how do we usually measure volatility aside from just looking at the graph? Is we can use a simple indicator. If I may, I want to divert your attention to the bottom part of the chart. We can use an indicator called the average true range, which is ATR in short, to measure if the asset class has a large volatility or a slow volatility. Now, compared to 2021, right? I want to divert your attention to the left and right. Now, compared to 2021, 2022, gold actually experienced a heightened volatility. What does this mean? This means, right, in 2022, there's a gold, right, might actually move a larger range compared to 2021. So what does this mean? This means that there are a lot of movement in the market in gold since last year. And what you can do if you are holding gold, or for those of you who invest in physical gold bars or gold coins, all right, what you can do is that you can use gold futures to hedge against any downside risk in the market. So this is something that you can consider using instruments like FGLD to help you protect your portfolio. Now, aside from this, right, aside from hedging against the volatility in the market, what you can do, there are also other opportunities in the market, which you can, for those of you who are shorter term or medium term trader, you can consider paying attention to fundamentals like the real yield. Now, for those of you who have not heard of real yield before, let me quickly explain what is a real yield. Now, real yield, if you look at the orange wording or orange sentence in the chart, real yield is equivalent to yield minus expected or real inflation rate. Let's discuss the yield part first. What is yield in this context, right? Yield in this context means or refers to the interest that an investor receives when they invest in, let's say, a US bond, right, or US government bond. Now, when you take a yield from a US government bond minus the expected or the actual inflation rate, you get the real yield, right? So as an example, let's say we have a yield, let's say US bond have a 3% yield, and there's the inflation rate is 2%. So 3% minus 2%, the real yield is, ladies and gentlemen, 1%. Now, why is this real yield important? Why is this really important? This is because when real yield is positive, which means when the yield is higher than the inflation rate, right? This is actually a good thing to a market where gold, this implies, right, that the market is doing well, the economy is doing well, and on the other hand, gold being something like a safe haven, right? Something like a fear, like people tend to flock to when they are fearful, right? When the market is good, when the economy is good, people tend to dismiss gold, right? And this sort of have an inverse relationship to gold. So let me show you what I mean, right? So let's say, right, when the real yield is negative, right? When you can look at the first red highlighted square, when the real yield go into the negative territory, what this means is it shows that there is a potential dangerous or the fear in the market, and this actually caused the gold price to actually goes up. Now, because of this inverse relationship, right? This also means that when the real yield goes up, right, goes into a positive territory, this also causes the gold price to goes down at the same time. So as you can see on your most right corner, right, of the chart, in 2022 or 2023, right, the gold price actually goes down, right, in May to October 2022 when the real yield goes up. Now, so what does this mean, right? So to explain further, why this inverse relationship appears between real yield and gold? First of all, right, real yield or a positive real yield implies that the economic condition is good, or the future growth, people have a good idea about the future growth of the economy. As such, gold being sometimes viewed as a fear indicator, right? When the economy is good, right, people tend to lose interest towards gold, and hence the price of gold tend to not perform as well, right? There are also actually a second reason. Remember that when people invest in bond, it provides yield, right, or interest to the investors. Now, if real yield is positive, this means that there's an opportunity cost for investor to invest in gold. Why? Because gold does not produce yield, right? Imagine when you invest in gold, you do not receive interest. Make sense? Now, and as such, right, when real yield is positive, right, there's an opportunity cost for you to hold gold, right? On the other hand, when the real yield goes into a negative territory, now investors have the opportunity, or at least have the incentive, to actually invest in gold, because since the real yield is already negative, right? You have the space, right? The opportunity cost to invest in gold is actually, it doesn't exist, right? So in fact, you have investors tend to take more risk to invest in non-yield assets like gold when real yield is negative. Now, so as such, for those of you who are shorter term to medium term traders, you can consider paying attention to this real yield. Now, a quick one before we continue, right? How do you look at this? How do you find this chart over here, right? For those of you who are interested to find out yourself, you can go into search for FRED, right? FED on Google, and you can look for this information here. You can search for market yield on US Treasury securities at 10-year constant maturity. Now, and you can look at the information. Now, aside from that, right, there are another fundamental opportunity that you guys, all of you can look for as a gold investor or traders, right? Which leads me to opportunity number 3, right? Pay attention to the banking sector. Now, when I say banking sector, I think most of you already know what's happening around us early this year, right? There's a lot of news around of fear banking sector, example with the Silicon Valley Bank, right? And so on, right? So as such, right, in this slide, I'm going to show you some of the opportunity, right? So what you can see here is essentially gold has an inverse relationship compared to the banking sector. What do I mean by this? What do I mean by this? Essentially, when the banking sector doesn't do well, right, gold tend to goes up, right? As you can see over here, right? When the banking sector do well, right, the gold as an asset tend to perform not as well, right? And vice versa. So I want to divert your attention, especially to the right side of the chart, where all of us have known what is happening around the world in the banking sector this year, right? As you can see, the banking sector actually performed badly in 2023. Meanwhile, what's happening to gold as an asset class, right? Gold is actually rising to all-time high, right? Which also proves the inverse relationship between gold and the banking sector. Okay, now the question would be why is the case, right? Why is there an inverse relationship between gold and the banking sector? The reason here is because the banking sector is actually a very important industry or sector in the economy, right? What the banking sector represents, what? Right? It represents, if the banking sector is doing well, it represents as a whole, in general, the health of the economy, right? Because the banks, what they do essentially is they create capital for people to take loans and so on, right? And they also provide liquidity, right? They provide loans to people and they pump out capital to the market. Now, if the banks are doing badly, it implies ultimately, right, in general, is the economy might not be doing as well. So this also gives the opportunity for gold to outperform banks in these times of challenging market. Okay, so as such, right, a key point to remember here is gold has an inverse relationship compared to the banking sector. Now, how do you get this chart over here that I'm showing all of you today, right? What you can do is essentially you can go to your charting software. Example over here is from TradingView. What you can do is you can just plot a gold price. You can open out a gold chart and you compare it to the banking index. In this case, you can type in the ticker BANK from Nasdaq, right, which tracks the performance of banks in general in the US. All right, and you'll get this comparison chart. Okay, and you can try it out for yourself. Now, we have talked about gold and the inverse relationship with the banking sector. Now, there's one last opportunity which I think is very relevant regardless if you are a long-term trader, investor, or short, or whether you are a medium-term or to a shorter-term trader. This which leads me to the last opportunity of the day, because now, ladies and gentlemen, today we have talked about we have debunked that gold isn't actually a stable asset. We have also debunked that gold is actually doesn't protect you from inflation as much as people tend to assume. So what's the purpose of having gold in your portfolio? The last and final opportunity that I want to share with all of you here today is gold is actually a good or in fact an excellent portfolio diversifier. What do I mean by this? This is because, right, over a 30-year period from 1993 to 2022, gold exhibited or shows a low correlation to major equity or stocks and fixed income indices. Now, let me just show you this chart over here. The first chart that you guys are seeing here is gold's correlation compared to major equity indices like the S&P 500, the Russell 2000, right, and the MSCI World Index, right, which shows the performance of stocks around the world. Now, what you can see over here is the lower the gold correlationship to the nearer it is to zero, right, the lower the correlation between gold to the particular indices, right, or index. So as you can see in this first chart over here, gold actually have a low correlation compared to other equity indices, which means, right, when equity goes up, gold might not be going up, right? Or when equity goes down, right, gold might goes up and vice versa. So gold doesn't act as doesn't actually follow what the stock market does, right, in short. Now, how about bonds, right? Let me just show you the second chart over here, which is the gold's correlation to the fixed income or bond related indices. As you can see over here, compared to the T-bill or treasury bill, or compared to the US treasuries, right, or global bonds, right, gold actually exhibited also a low correlation compared to these bonds or fixed income assets. So what this means essentially, ladies and gentlemen, this is very important. Gold, when you have gold in your portfolio, it helps to lower the volatility in the portfolio, right? Let me show you what I mean. Now, the best way to visualize or let you see how gold is actually a good portfolio diversifier is let you see what happened last year. What happened last year, ladies and gentlemen? The market tanked, right? The market tanked, not just the stock market, even the bond market performed poorly as well. It's one of the rare years where bond and stocks perform poorly at the same time. But what happened with gold during this period, ladies and gentlemen? Bond, right, actually outperformed stocks and bonds, right, and actually produced a positive return at least until February of this year, right? Meanwhile, stocks and bonds actually fall over 15%, right? Until February of this year so far, right? So as you can see, if you hold gold, right, how helpful is it to your mental state where you can sleep at night knowing that your losses or your drawdown are actually buffered? Now, to show this further, right, to help you visualize this further, I'll do this comparison, right? How gold is a good portfolio diversifier. Let me just show you a simulation, right? In this simulation, I will share with you two assumptions. The first assumption is where we'll start in 1972 to January of 2023. And we'll start with a capital of $500 or ringgit, right? It doesn't matter. And do a monthly contribution of $500, right? So what will happen, right? In this case, right, we'll compare three portfolio. The first portfolio is a portfolio with 100% US stocks. The second portfolio is a portfolio with 90% US stocks and 10% gold. And the final and third portfolio is US stock 80% and gold 20%. Let's see what's the result, right? When I zoom into the result over here, you can see, right, the first portfolio and the second and third portfolio actually achieve a cumulative result or yearly return, right? Cumulative annual growth rate of about 22.4% to 22.7%. So in short, what this means, right, in annual return basis, right, these three portfolios actually perform quite similar, right? The margin of difference is actually very small. But when you look at the maximum drawdown, which means, right, how high and low, right? How low can it drop from its peak of its performance, right? You can see over here, the portfolio with 100% US stocks actually have experienced a maximum drawdown of more than 50%. Meanwhile, the two other portfolios with gold actually perform much better or have experienced a much lower drawdown, which is, in other words, right, having 10 to 20% of gold allocation in your stock portfolio reduces maximum drawdown by about 11 to 23%. So what does this mean, right? What does this number mean? So I believe those of you who invest in the stock market last year, must have experienced a lot of mixed emotions with all the performance and so on, especially even more so for those of you who invested in cryptocurrencies and high tech related stocks, right? So you can imagine if instead of losing over 50%, you are actually just incurring about 38% of losses, right? It will help you a lot in your mental state, right? Especially in your fear of investing, right? Your FOMO and so on. All right. Now, I just want to show you, right? And to emphasize on my point, right? What are some of the benefits of holding a gold in your portfolio? It helps to significantly improve drawdown recovery time. What do I mean by this? So in this screenshots over here, we are again comparing three portfolio, 100% stocks and 90% stocks and 10% gold. And the third portfolio is 80% stocks and 20% gold, right? And for this purpose, I use the previous two crises that we had, which is the first one in 2007, 2008, which is the great global financial crisis. And the second crisis is the dot-com bubble in year 2000. Now, so when you can see over here, right, if you own 100% US stock portfolio during that time, right, your portfolio would recover by March 2012, right, for the first crisis. Now, if you own the second portfolio, which is 90% stocks and 10% gold in the middle, right, your portfolio will actually recover by February 2011, which is almost 1 year earlier, right? And if you own 20% of gold in your portfolio will recover in the third screenshot, would recover by December 2010. So you can see the difference. How fast would your portfolio recover if you have gold in your whole entire portfolio instead of just 100% equities or stocks? Now, let's use another example, which is the dot-com bubble in year 2000, right? So if you invested in 100% stocks, right, during the dot-com bubble, your portfolio will recover by October 2006, right? And if you hold 10% of gold, just 10% of gold in your portfolio will take about 9 to 10 months earlier to recover, which is January 2006, right? And lastly, if you hold 20% of gold in your portfolio, ladies and gentlemen, your portfolio would recover by December 2004, which is about what more than 2 years, right? It's about 2 years earlier compared to if you invest in stocks at 100% stocks. Now, so all this comparison, what I'm trying to imply here is quite simple, right? Instead of looking at stocks as a stable asset, or instead of looking at stocks as a good inflation protection or hedge against your wealth, right? Look at gold. Look at gold as a insurance to your portfolio, where when things goes bad, when things become tough in the market, right, it helps give you a peace of mind, right, by buffering your drawdown and improve your drawdown recovery time, right? Okay, Make sense? Now, with all that in mind, right, I want to share with you what are some of the ways you can invest or get exposure to gold, right? So what happened late last year was Bursa we actually come out with this futures product, local futures product which tracks gold, which is the ticker is called FGLD. So what it does is essentially is a US dollar denominated product which is settled in ringgit Malaysia, right? That's traded in Bursa, and it's designed to actually help you gain exposure to gold market without having to store physical gold. So if you are not a fans of actually having like a gold in at home, right, or you are afraid of having gold, of the danger of storing gold in your cupboard or under your bed, right? FGLD is actually a good choice, right? And not only that, right? Why FGLD? Because it is regulated by the Securities Commission. So it ensures that the asset is always secure and transparent. And lastly, because it's denominated in US dollar and settled in Malaysia ringgit, right? It has a fixed multiplier of 40, which reduces currency fluctuation risk. Don't worry about this. I'll show you an example of how this whole trading FGLD works later in the later example. Now, why trade FGLD or why trade gold futures, right? The first reason is because, right, with gold futures, right, you can trade gold in both directions, which means, like, when gold goes up, you can trade on the when you can trade on the long side. When gold goes down, right, you can trade on the short side, which means you can make a profit whether gold as an asset goes up or down, right? Which is a very flexible asset class. Now, you can also, for those of you who hold gold, right, you can use FGLD to hedge against any downside risk in the physical gold market, which I'm going to show you an example later on how to use it. And lastly, with gold as a futures product, right, you gain access to leverage, which means actually the capital required to trade gold is actually much lower. Now, in this slide, I want to show you some of the choices that you have for those of you who are interested to have exposure to gold, right? There are mainly three ways that you can invest in gold or have exposure to gold. Number one is through gold futures or FGLD listed in Malaysia, right? Secondly is the gold ETF listed in Malaysia. And lastly, you can gain, which is the most, I would say, the traditional way of owning gold is to own physical gold coins or bars, right? Now, I'm just quickly comparing the benefits of or the features of all these three solutions, right? Number one, the convenience of not having to store physical gold, right? You get this in gold futures, you get this by investing in gold ETF in Malaysia. But when you invest in physical gold, you have to figure out a way to store your gold, right? But most likely you're gonna buy a safe deposit box and so on in order to store your gold, right? And this is another cost that you have to consider. Okay, so when it comes to directional trading, which means you can go go long or short, right? When the market goes up or down, right? Only gold futures allow you to do that because it has the flexibility as a derivative for you to go long or short, right? When compared to gold ETF and physical gold, right? This you buy invest in this mainly the only way you can profit from this gold ETF or physical gold is when the prices goes up, right? Now, hedging means you can protect your portfolio when the price of gold goes down, right? You can do so with FGLD as well because you can short the FGLD, right? And on the other hand, you can't do so with gold ETF and physical gold as well. So from this, right, we can actually see that FGLD provides you a lot more flexibility, right? As a trader, as an investor, right? To protect your portfolio, right? Talking about that, right? FGLD also provides leverage, right? For those trade, especially shorter term to medium term traders, right? Who require leverage, right? FGLD provide you leverage to trade. And meanwhile, as for gold ETF that are listed in the stock market, right? It really depends on your broker whether you have a margin account to do so or not. So it's something that is determined by the broker, right? It's not something that is already rated for you, right? Meanwhile, for gold, you can't really get access to leverage because you can't, right, in the physical market. Now, let's talk about fees, right? When it comes to all these three choices of getting gold exposure, right? For gold futures, right? As per anything, you need a broker to trade FGLD, so you got pay brokerage fee. But the good news here is, FGLD, there's a waiver on exchange and clearing fee when you trade FGLD from the 2nd of February to the 30th of June 2023. So for those of you who are interested to give FGLD a try, right, here are some perks that you can enjoy when you trade FGLD until the end of June. Now, meanwhile, when you invest in gold ETF, right, you gotta pay what? Brokerage fee, you gotta pay exchange fee, you gotta pay clearing fee, which is typical fees charged by all brokerages and exchanges in the stock market. Now, as for physical gold, as I mentioned just now, when you buy physical gold, you gotta consider the cost of storing gold, right? Most likely, you gotta either subscribe to a deposit service and so on in order to store your gold. Okay, so these are some of the fees that incur among all these three options of gold. Okay, now in this just now I did promise all of you to show you how you can use FGLD to invest or trade gold, right? So let me just show you some example. The first example is how you can use FGLD to profit when gold is in a bull market. So example over here is James. Let's say James is bullish on gold. All right. So what James can do is he can long FGLD. So James long one contract of FGLD at $1,800 per troy ounce, which means, right, James, sorry for the typo, bought one contract of FGLD futures when the price is $1,800. So what happened when James is correct and gold indeed rises to $2,000 of 2,000, right? James make a profit as he sell off his position, right, at $2,000. So how much does James make? In this case, right, he makes 8,000 ringgit from this transaction. So how do we calculate it? We use $2,000 minus the entry price of 1.8K, right? Times by one contract, remember, because he long one contract of FGLD, times by a fixed multiplier of 40, right? So in this case, right, regardless if US dollar swings up or down, right, compared to a Malaysia ringgit, the multiplier is always 40. So you see a benefit here, which is regardless of what's happening between the exchange rate between the Malaysia ringgit and the US dollar, right? The multiplier is always fixed. So your exposure to currency fluctuation, right, is actually much more stable. So in this case, when bull market, right, James actually make about 8,000 ringgit from this transaction. Now, how about let's say when as a gold coin holder or gold bar investor, right, you have a feeling that gold is actually going down. There's a bear market coming, right? You can also use FGLD to hedge against the downside risk in gold. All right. So let's say James owns like 10 troy ounces of gold coins, which is about 311 grams. Now, so let's assume gold is trading at 1.8K US dollar per troy ounce right now. And in this right now, James believes that gold price will actually go down. So what can James do, right? So he goes to the futures market and short one FGLD contract at 1.8K to protect his gold portfolio. So how can he do that? Is by selling or shorting one FGLD contract. Because remember, with futures, you can go long and you can go short at the same time, right? It's very flexible. Now, so let's say if James conviction is indeed correct, right? Gold falls to US dollar 1.7K, right? And in this case, right, if James does not hedge with FGLD, what's his unrealized loss? In this case, right, 1.8K, right, minus 1.7K, which is the new gold price, right, times by 10 troy ounces because James owns 10 troy ounces of gold coins, times by, let's say the exchange rate is 4.4, right? So in this case, right, if James does not hedge his losses, James actually experienced a 4.4K in ringgit in terms of losses. Now, what if, right, in this scenario, he hedged with FGLD? How can he protect his downside? Now, in this case, James minimizes his losses as he closes his FGLD short position by buying back the one contract at 1.7K, right? So he makes about 4,000 ringgit from this trade. So our calculation is as of below, which is 1.8K minus 1.7K times like one contract of FGLD times the fixed multiplier of 40. So in the end, right, from this short trade, he makes about 4,000 ringgit. So with this example, right, James actually protected or actually limit his downside to just about 400 ringgit, right, compared to the scenario where he chooses not to hedge his portfolio. Okay, now make sense? Okay, now so these are just some of the tip of the iceberg of how you can use FGLD in your everyday trading and investing activities, right? By trading by making longing when the market is bullish, or you can short it to protect your portfolio, right, against a bear market. So I encourage all of you to actually give FGLD a try, right? And discover what are some of the benefits for yourself, right? When you trade FGLD. So without further ado, I just want to go through some of the details of FGLD, right? So the market hours of FGLD, right? The good thing with trading futures is unlike the stock market that only have almost week the morning the daily market hours, right? Futures market is available in the morning, right, in the afternoon, and even at night as well. So for those of you who are interested to have exposure to gold, right, your time is not limited, because when you're working, you might not have time to deal with the stock market, right? But with futures, you can do so even after work as well. So it's very flexible. Now, and even better, right? Remember the promo that I shared with all of you just now, right? For FGLD as a futures product, right? Bursa is currently doing a promotion where you can get a waiver on your exchange and clearing fees when you start to trade FGLD. And the promotion period is from the 2nd of February to the end of June. So for those of you who want to take advantage of this promotion, right, I encourage you to give FGLD a try, right? Experience for yourself what FGLD can do for your portfolio, for your investing and trading activities. Okay, now with that in mind, I want to quickly summarize what have we learned today, right? The 4 key takeaways for the day, right? If you want to take note, now's a good time, right? Number 1, as an individual asset, gold can be volatile, right? Even when inflation is high, right? So today we have proof, right, with statistics, with all the charts and the visuals, we have proof that gold is actually a very volatile asset. And it actually doesn't protect us from inflation as much as we wish it could, right? And secondly, gold has a strong inverse relationship with real yield and the health of the banking industry. Now, so this presents, right, the opportunity that you can consider or you can take into your fundamental analysis of your investing or trading activities, right? And thirdly, gold may not deliver a great return as an individual asset, but ladies and gentlemen, the low correlation between gold and stocks and bonds, right, means, right, gold is a great insurance to help reduce drawdown in a portfolio when the market is tough, right? So as I show all of you today, right, when you hold 10% or 20% of gold in your portfolio, based on past performance, right? Again, past performance is not indication of future performance, but based on past performance, actually help reduce the drawdown and improve the recovery time of the entire portfolio. All right. Now, finally, if you are interested, right, you can definitely try give the gold futures in Bursa, which is FGLD, a try, because you can use it to hedge against downside risk of gold, right? You can even trade gold to both upside and downside. So compared to other options in the market, right, it's actually a very flexible choice, right, to gain exposure to gold. Now, with that in mind, that is pretty much it, right? These are all the 4 key takeaways for the day. I hope those of you who attended the session today. I hope you enjoyed the session. I hope you learned something and insightful from the session. So I would like to actually pass back the floor to CY, our host today.